What if I told you that the biggest story in global finance right now, isn't the stock market, or inflation, or even gold's historic surge to new highs? What if the real shock, the one no one was prepared for, is happening in a metal almost everybody forgot? A metal that analysts spent years dismissing as too slow. A metal that traders believed could never catch up. A metal that governments quietly accumulated in the background while telling the public it didn't matter anymore. Suddenly, and almost without warning, silver has begun following gold's lead. Not gradually and not calmly, but with a violent breakout that has blindsided investors, rattled the derivatives market, and forced major institutions to rewrite their models in real time. Something big is happening. The question is, why now? What triggered this sudden chain reaction? And why are veteran traders whispering that this time, silver's move isn't just a spike, but a signal? To understand the shock unfolding in the market today, we have to go much deeper than headlines, back centuries, to the moment global money was born. Because what is happening to silver today is not random. It is a pattern repeating through financial history. For thousands of years, silver, not gold, was the backbone of world money. Gold was reserved for kings, treasures, and state power, but silver was used by civilizations. It paid soldiers, funded trade across empires, and acted as the daily lifeblood of economies from Rome to China. Unlike gold, which was collected and hoarded, silver flowed. Its supply rose and fell with human history. It tracked discoveries, wars, colonization, and industrial revolutions. Throughout history, gold represented stability while silver represented change. Silver was emotional, volatile, and tied to every major shift in global power. That history matters today because silver is still behaving the same way. Markets may treat silver as a commodity useful for jewelry or electronics, but historically, silver was the system itself. And when silver moves suddenly, it usually means the system underneath it is shifting too. Silver is a truth teller. It exposes financial stress long before gold does. And right now, after decades of being ignored, silver has woken up. To understand why, we have to look at the first major moment in modern history when silver followed gold's lead, the 1930s. In the early part of that decade, economies around the world were suffocating under massive debt, collapsing trade, and a global deflationary spiral. Nations scrambled to devalue their currencies, and gold surged first, just like it has in recent years. Meanwhile, silver remained eerily quiet. Analysts at the time called it dead money, claiming the silver era had passed. They were wrong. When gold stabilized at its new, higher valuation, silver suddenly exploded. Not slowly, not predictably, but violently, doubling and then tripling in a short period. Why? Because silver had been artificially suppressed by governments and financial institutions trying desperately to stabilize collapsing currencies. Once those controls broke down, silver reacted with decades of stored force, revealing the true stress in the system. This is an important pattern. Every time gold reprices during a monetary shift, silver lags behind until the dam breaks. And when it breaks, silver doesn't follow gently. It catches up with a vengeance. That pattern repeated in the 1970s. Gold again moved first as inflation spiraled out of control. It rose from $35 to over $800 in a decade. Silver, however, remained stagnant for years. Economists insisted silver had lost its monetary relevance. But when silver finally reacted, it didn't just rise, it detonated. In one of the most dramatic moves in financial history, silver shot from around $1.50 to nearly $50, a more than 3,000% increase. Many people blame this move on the Hunt brothers, but that explanation is too simple. They were part of the story, but not the cause. The deeper truth was that the silver market had become artificially compressed under the weight of industrial demand and financial manipulation. Once gold forced the global monetary system to revalue itself, silver, being tied both to money and industry, was yanked upward with extraordinary force. The 1970s created a second template that still holds today. Gold signals the shift, and silver amplifies it. The next warning shot came before the 2008 crisis. In the years leading up to the financial meltdown, gold began creeping upward as investors feared instability. Silver, once again, lagged. But right before the global panic reached its peak, silver erupted, rising from around $12 to nearly $49 in under 3 years. What made this move different from previous cycles was silver's new industrial role. Silver had become essential to modern technology, electronics, medical devices, cars, batteries, semiconductors, and solar panels. The world had unknowingly built an industrial civilization on top of a metal that had historically been treated as money. This hybrid nature made silver explosive in a crisis. When investors panic, gold rises, but when investors panic and industries panic, silver erupts. The 2008 move showed that silver was no longer just a monetary metal. It had become a critical industrial resource that could no longer be replaced easily. This set the stage for the crisis we are experiencing today. Now, fast forward to the present. Over the past year, gold reached new all-time highs as central banks accelerated their purchases and global uncertainty rose. Gold moving wasn't the surprise. Analysts expected that. What shocked the market was silver. For months, silver refused to move. It lagged behind gold more than usual. Analysts downgraded their forecasts and called silver the most disappointing metal of the decade. Retail investors gave up. But behind the scenes, something was building, something structural, not emotional. Then, without warning, silver followed gold's lead with a breakout that sent shockwaves through metals markets. This wasn't speculation. It wasn't momentum trading. It was the result of three deep structural forces converging. The first force was physical demand. Industrial consumption of silver surged to record levels. Solar manufacturing exploded. Electronic supply chains expanded. Governments quietly began stockpiling silver as they accelerated renewable energy infrastructure. Suddenly, physical demand overtook mining supply. This had never happened at such scale before. The second force was derivatives. For years, silver's price had been held down by large paper short positions controlled by a handful of major banks. These financial institutions maintained enormous influence over silver's price behavior. But as industrial buyers began demanding physical delivery, not paper contracts, the derivative market was forced into a dangerous squeeze. Paper silver had far outgrown real silver, and the mismatch finally broke. The third force was the global monetary environment. Central banks were diversifying away from the dollar. Geopolitical risk reached multi-decade highs. Inflation distorted currency valuations worldwide, and physical gold buying reached levels not seen in 70 years. Historically, when gold reserves shift, silver eventually follows. The time lag between the two metals this time fits perfectly with past cycles. To understand what's happening now, we need to break down the exact chain reaction unfolding today. First, gold rises due to monetary stress, debt, inflation, war, and currency instability. Second, central banks increase their gold purchases, signaling distrust in fiat systems. Third, silver remains suppressed temporarily due to industrial pressure and derivative market manipulation. Fourth, physical shortages begin to appear as mining output fails to match demand. Fifth, industrial buyers, companies that need silver for manufacturing, panic before investors do. They must secure silver or risk halting production. Sixth, banks holding large short positions find themselves under pressure, triggering a short squeeze. Seventh, silver breaks out with sudden force. And eighth, investors realize this breakout isn't a temporary spike but a structural shift in the global financial system. That is the moment we are living in right now. The most alarming part is the data. The world is running out of easily accessible silver. Mining grades are dropping. Recycling isn't scaling. Industrial usage is accelerating at the fastest pace in history. Unlike gold, which sits in vaults for decades, silver is consumed. Once silver goes into a smartphone, a car, a battery, or a solar panel, it rarely returns to the market. Analysts estimate that more than half the silver ever mined is gone forever. Industrial demand now consumes more than 60% of annual production, and most silver doesn't come from primary silver mines. It's produced as a byproduct of mining other metals. That means even if silver prices quadruple, mining supply cannot simply scale up. This creates a scenario the modern world has never faced before. A monetary metal experiencing structural shortage during a global monetary shift. This is why the breakout shocked institutions. The math they relied on stopped working. Their models broke. Their supply assumptions broke. Their forecasts broke. Silver suddenly changed from a commodity into a strategic choke point. And when a financial system meets a choke point, everything downstream must adjust: currencies, markets, industries, and governments. If the historical pattern holds, silver is now entering the same explosive phase seen in the 1930s, the 1970s, and the aftermath of 2008. Each of those periods marked a transformation in global money. Consider the parallels. In the 1930s, economic collapse forced nations to revalue gold, and silver erupted afterward. In the 1970s, inflation destroyed faith in paper money, gold exploded, and silver followed with even more force. In the late 2000s, a credit bubble broke the global financial system, gold spiked, and silver surged with violent speed. Today we face an eerily similar setup: record global debt, inflation waves, currency instability, geopolitical tension, and exploding industrial demand. Gold has already signaled the shift. Silver is now confirming it. And if history repeats, and it usually does, silver's move will be larger, faster, and more disruptive than gold's. If the cycle continues, silver is heading into a future shaped by tightening supply, industrial panic buying, derivative compression, monetary repricing, psychological fear of missing out, and eventual government intervention. This combination is incredibly rare. In the past century it has occurred only twice, and each time it reshaped global finance. The question is not whether silver will be volatile, it will be extremely volatile. The question is how quickly the system adjusts to the new reality. Silver is both a monetary metal and an industrial lifeline. That dual identity makes it uniquely explosive during monetary transitions. It also makes it unpredictable. Silver doesn't move in calm, rational increments. When it decides to move, it runs. And when it runs, it overshoots, often violently, because it is correcting years of suppressed pricing. So what are the key lessons from everything we've uncovered? First, history shows that silver always follows gold during major monetary shifts. Sometimes it lags, sometimes it pauses, but it always follows, and usually with far more force. Second, today's breakout is structural, not speculative. It's driven by physical shortages, industrial stress, and monetary realignment, not hype. And third, the world is repeating the same historical conditions that have triggered every major revaluation of silver in the last 100 years. Debt, inflation, geopolitical conflict, and distrust in currency systems always lead to gold revaluation, and silver always amplifies it. You don't need to predict the future to understand what's happening right now. You only need to recognize the pattern. The world is entering another monetary cycle. Gold is sounding the alarm, silver is confirming it, and the financial system is shifting beneath our feet. Whether you invest in metals or simply want to understand global change, this is one of the most important transitions of the century. Because once silver breaks out fully, the window to analyze the shift closes. If you found this breakdown valuable, stay curious, keep learning, and most importantly, understand the deeper story behind the headlines. The next chapter of this monetary cycle is coming, and you will want to be ready for it.